D2L is finally IPO'd on the Toronto Stock Exchange. And in today's video, I'm going to break down D2L and my thesis as to why I bought shares in D2L. Stick around till the very end because I'll show you how many shares I bought and what is my cost basis. The TLDR for my analysis is basically, I think D2L is reasonably priced and probably undervalued. We'll get into the reasons why I think it's undervalued in my more thorough analysis. But starting off, let's talk about the mission of D2L. The purpose of D2L is building better learning experiences. And how they're doing this is not just creating an LMS or a learning management system, but they're allowing the users, aka the teachers, personalize the experiences for all the learners. And this in theory should help the learners excel in their learning. There's three main categories of customers. They've got their K-12, they've got higher education like college or university, as well as they've got corporate customers. The regular education sector, which is like K-12 as well as college and university, is going to continue to increase over time. And that's because people are spending more time in school. If you rewind back 20 years, people back then didn't necessarily need to go to college or university in order to start working a fairly decent paying job. However, nowadays it's very difficult to make a decent living if you don't have at least a bachelor's degree. And I predict going forwards in the future, the bachelor degree is going to end up being like the high school degree 20 years ago, where everyone's going to have a bachelor's degree or at least a college degree. And the only way to stand out is to get a master's or a PhD. And right now we're already seeing that transition where a bachelor's is kind of useless unless it's a very specific bachelor degree. So in order to secure a better job in today's economy, you have to get a master's or a PhD to really stand out. And with students staying longer in the education system, this is only going to benefit D2L even more. But after people get out of the education system, they don't stop learning. In the corporate world, you're always constantly learning as well. You need to adapt to the changing environments, and the only way to do so is by upping your skills and making sure that they stay sharp. So D2L also provides a corporate LMS to corporations where they can help their employees sharpen their skills up as well as stay relevant in their industry. And if you don't believe my trends, well, there has been some research done in the learning environment market. It's going to grow from 2019 at $13.1 billion to 2025, it's going to be $43 billion. And in this market, there is learning management systems, virtual learning, and a lot of things to do with technology in learning. D2L is also evidence that this market is growing because they've been growing their revenue at 15 to 20% year over year. And they plan to grow 20 to 25% in the next 5 years. In their most recent year in 2020, they saw their customers increase by 33%. On top of that, they saw revenue growth of 15%. Although revenue growth lagged customer growth, this is not a bad thing because when new customers come onto the platform, they usually want to try things out and they don't invest that much. However, once they realize the value they're getting from the platform, that's when they start to increase their spend on D2L's platform. So D2L capturing a lot of customers right now, keeping them in their ecosystem, they can continue to upsell them in the future and drive more revenue. D2L does believe that they're going to be able to capture more revenue going forward because currently the market is very fragmented. Only about 4% of global spending on education is towards technology. And I think that technology is the future of learning because technology will be able to accelerate how information gets passed from the teacher to the learner. As well as with more visuals, it just makes learning a lot more engaging. And for D2L to capture more revenue, they're going to have to spend in the midterm a lot more money on sales and marketing. And right now, it's really about accelerating their growth by increasing sales and marketing and development and really foregoing those profits. And a lot of growth companies employ this strategy because if you can capture the customers right now, keep them in your ecosystem, and once the market is saturated for the LMS market, then you can take your foot off the gas and allow your LMS to just rake in profits. Those profits could be used to pay back shareholders in the form of dividends, or it can be used to invest in other areas of learning to grow the company even larger. And for D2L to succeed, they're going to have a little bit of luck as well as a very unified team. And the way that I can judge if a team is unified, typically I go to Glassdoor. And right now when I look at Glassdoor for D2L, employees there are very happy and they approve of management. 89% of the people who have put their review on D2L recommend the company to a friend to work for, as well as 94% of the employees who have put a review on D2L approve of the CEO. Now let's turn our attention over how we're going to value D2L as a company. Well, the best way to value a company usually is to look at their peers and what their valuations are. So some of the competitors that D2L has are Docebo, Instructure Holdings, which makes the Canvas platform, basically a competing LMS, Thinkific, Duolingo, and PowerSchool Holdings. The PS ratios of these companies is how we're going to compare them. So Docebo currently has a PS ratio of around 23, Instructure Holdings is around 8, Thinkific has a PS ratio of around 19, Duolingo has a PS ratio of 27, and PowerSchool Holdings has a PS ratio of 8. And if we look at D2L, their PS ratio is sitting just above 5. Now earlier I did some spreadsheeting, and if D2L had a PS ratio of 8, you would see a 58% increase on your investment. If you're looking for the current market cap, it sits under $1 billion. And when they first were about to IPO, they announced that D2L could be a $1 billion company, but they didn't break that $1 billion mark with their IPO. Now, based on D2L's guidance, I did some projections 5 years out. They projected 20 to 25% increase in revenue year over year. So after 5 years, if we go on the low end of 20%, their revenue will grow to 446 million Canadian dollars. Currently, they have $179 million of annual recurring revenue. On their prospectus, it does state 144 million, but that's in USD. For us, we're going to convert everything to Canadian because we are investing in Canadian dollars, as well as the share price is in Canadian dollars. I also model out the free cash flow, which they predict will be 10 to 20% of revenue. So by year 5, their free cash flow will be anywhere from $44 to $89 million. And if they have a PS ratio of 5 all the way out to year 5, then the market cap will be $2.2 billion. And if you were to buy shares today, you're going to see an increase in your shares of 148 percentage points. Now, if revenue increased by 25%, by year 5, the revenue would be $547 million. Free cash flow at 10% is $54 million, and at 20%, it's $109 million. Now, if the PS ratio stuck at 5, which is, again, low in my opinion, we would see a market cap of $2.7 billion, and that would mean your investment has increased by 205%, or it's tripled. Now, if we change the PS ratio to 8, then you can see your investment would go up by 383% in the best case scenario, or 293% in their worst case scenario that they guided. And if the PS ratio went to 10 or above, even to 20, then you would see a 10x increase on your investment best case. Now let's apply some margin of safety and assume that they only grow 15% year over year for the next 5 years. Then your percentage increase on your investment, assuming a PS ratio of 5, will be 101%, or essentially you'll double your money in 5 years. Now going back to the original point when we started off in the spreadsheet, I believe that D2L should at least command a PS ratio of 8, especially with a growth of 20 to 25% organic growth. Now, of course, they could do acquisitions and accelerate the revenue growth through acquisitions. However, there's no point in accounting for that in these calculations. Now, it's kind of puzzling as to why D2L has a PS ratio of 5 when all their competitors are 8 and above. And looking at all the other previous facts where the company is growing at 20 to 25% in the next 5 years, they have happy employees, I think that D2L is undervalued. And when D2L went through the IPO, they priced their shares initially at $19 to $20. However, they dropped their IPO price to $17, and when they IPO'd, there was no big pop. Currently, the shares sit at $16.73. And I think that maybe there just isn't any appetite for Canadian stocks right now. If we look at all the recent Canadian IPOs that happened this past year, a lot of them have had lackluster performance. Only a handful have performed very well, like Magnet Forensics, where it rose from around $13 all the way to $56. However, it's dropped back down to around the mid-30s right now. But when evaluating a lot of these Canadian IPOs, oftentimes they start out at their IPO price, a couple of days later they pop up maybe by 20, 30, 40%, and sometimes go for a huge run before pulling back. So right now it's in the early days of D2L. They just IPO'd this past week, and they've only had a couple days in the market. Perhaps we could see a pop in the next week or so. However, for me, I'm investing in D2L more for the long term, just because I see there's good growth ahead of them. D2L should be able to increase the revenues not just through customer growth, but also economies of scale. In 2019, they finally moved their platform to the cloud, and they already saw cost savings of around 5%. And this should only go up as they increase the number of customers because they can pay less for cloud services. The savings should continue to rack up as they increase their customer base because of economies of scale. Now, if you're wondering how many shares I bought, currently I have about 20 shares of D2L. My cost basis is $16.40. I think that I'll continue to buy D2L slowly over the next couple of weeks or couple months. Maybe the price might drop to about 15 or 14, and I'll continue to add more. However, for me, there's not any rush to get into D2L. There is still some risk because the company is not profitable, and for that reason, I'm not jumping the gun and buying all my shares right now. I'll probably grow this position to about $1,000 to $2,000 of my own money and just see where it goes in the next 5 years. If you're interested to see when I buy D2L next, you can check out my Patreon link down below where I disclose all my buys and sells. There's also other goodies in the description down below, so go check that out if you have a chance. Remember to leave a like if this video was helpful for you because that really helps me out as a creator. I've got a couple videos up on the screen for you, so if you want to check them out, I'll see you there. If not, keep up the grind and have a great day.